Hello, we are going to talk about Chapter 20, the inventory cost management strategies. Okay, so we're going to learn about what is the economic order quantity, okay? EOQ, economic order quantity. We're gonna learn about the benefit and the cost of just-in-time inventory managing system, okay? And there are different management, materials requirement planning, MRP, enterprise resource planning, ERP, and also the backflash costing method. Inventory management is planning, coordinating, and controlling activity related to the flow of inventory into, through, and out of an organization. Okay, so inventory management is simply put, manage the inventory, right? So anything related to the inventory, what comes in, what comes out, what happened between, right? So that's the whole process involved related to the inventory. The goal, of course, is to lower the cost, increase net income, right? That's why this one is called cost accounting, right? We want to increase the net income for the corporation by reducing the cost. So what are the costs associated with inventory management? So we have 6 categories. First one, purchasing cost. Second, so when you purchase, you have to pay the supplier. They won't give it for you for free. Ordering cost. So when you place the order, you need to have maybe an ordering department, right? People will be there to making orders, right? So there's a cost on that. Carrying cost, right? If you have inventory, you have to place them on the floor or on the warehouse, right? You have to store them, safeguard them, so they won't be stolen, right? So, and then they take up the space. It's very expensive when you rent a warehouse or, so the cost of carrying this inventory. Stock out cost. In occasions that, you are running out of inventory, you probably have to, get additional inventories right away, right? To meet the sales demand. So that's the additional cost. Costs of quality and the shrinkage cost, right? So shrinkage cost would be, let's say you importing the vegetables and the vegetables are spoiled during the transit. Cost of quantities, you want to make sure that those products is good quality, right? Good quality. Purchasing cost cost of goods acquired from suppliers. So that would including the freight in cost, transportation cost. Ordering costs, preparing and issuing purchase orders. Okay. Carrying cost, holding inventories goods for sale. Stock costs occurred when company runs out of particular items. Okay. Company must quickly to meet the demand. Otherwise, the company will suffer the cost of not meeting it, right? Cost of quality. Maybe your product is not meet the customer's requirement. Okay. Shrinkage from theft, right? Clerical errors, right? Shrinkage cost. Economic order quantity procurement model. So the first decision is to how much to order. Okay. Okay, so you think about, okay, I guess it's very easy to think this way. If I want to make sure I have enough to sell, I will order more, right? When I order more, maybe that will save my ordering cost, right? I don't have to always order small batches. If I just order big batches, it's gonna cost me less money in terms of ordering, but the carrying cost is higher, right? You order this much inventory, where are you going to put it? If you have to rent another warehouse, that's additional rent cost, right? So you may save your ordering cost by placing orders with large batches, units, but you get it, they cannot be sold right away. Where are you going to put these items? So the carrying cost will be high, even though your ordering cost is lower, right? So then there's a balance. You have to find that perfect balance that to minimize your cost. At one point, if I order this much, guess what? The total ordering cost and carrying cost is the minimum. Right? So that's what this EOQ is about. Economic order quantity is about. This is the decision model that calculates the optimal quantity of inventory to order. So this is just a calculation of what inventory to order that will give you the lowest cost. This model is based on a set of assumptions, okay? So the assumptions is every time at each reorder point, they reorder the same quantity. So every 2 weeks, I order 100 units, right? So at each reorder point, I'm ordering the same amount of quantity. Demand, purchase order, lead time, ordering cost, carry cost are certain. So demand is certain. I know how much I can sell. Purchase order lead time, okay? So I know if I order now, 2 weeks from now, I'm going to receive it. So this is certain. Ordering cost, how much it costs me to order for each order, that is certain. Carrying cost is certain. How much it costs me to carry a unit in the inventory, the carrying cost is certain. So with this, right, and the purchasing cost are not affected by the volume. So in the real life, if you order more, right, you often get a discount. But in this model, we assume that the purchasing costs are not affected by the quantity ordered. No stockouts occurred. So because the demand is certain, right? You already sell this much demand, so therefore there's no surprise, right? You don't need to. It's not like sales go up. No, I'm running out of stock, running out of inventory, so that won't happen, right? Costs of quantity and shrinkage are only considered if they affect ordering or carrying cost. They won't be considered. Cost of quality and shrinkage are not considered only if they will be only considered if they affect ordering or carrying cost. So the formula is that economic order quantity is square root 2 times demand times ordering cost per order divided by carrying cost per unit, C. So EOQ equals square root 2 times D times P divided by C. D is the demand, okay, in unit for the specific period of time. So that how much you can sell, right? P is the purchase, the ordering cost per order. C is the carrying cost per unit. So how can we get this, right? So this is what happened. You don't have to know this, but I want to convince you this is true, okay? So basically, you can assume you need to order X units. For each order, you need to order X units, okay? So if for each order, you order X units, and during the period, you need a D, so the total order has to be D divided by X, right? You have to order this number of times. And each time you have X units, so that for that period, you ordered exactly the demand, right? The D, right? So you ordered D over X times, So the number of times order, okay? The number of times ordering is D over X. Each time you order the X. So in total, you order the D. That's for your demand, right? So what's the ordering cost? The number of order is D over X, and the cost per order is P. So I have P times D divided by X. This is my ordering cost. And then what's the carrying cost, right? What's the carrying cost? So this is your picture. Okay. So suppose in the beginning, you have X, right? And then you sell it. This one will decline, okay? And then if you ordered early enough, it just happened at this time, you get X again, right? And then you sell it, it comes down, okay? And then if you reordered at a point, right? So let's say you ordered here so that you can receive the new order right here, right? So every time you have a new order received, so you can see that the level of the inventory at the highest is X, right? It's X because that's the number of units you ordered. And at the lowest is 0, right? That's the end of the that's the time you receive, if it's perfect, right? If it's perfect in my model, it's perfectly when I sold everything, the new order came, right? So the previous old order has been sold, dropped to X, but I have a new order, X, right? So you can see that this is what happened, right? So my inventory goes from, at the beginning I have an X, and it's down to 0, and then right on that high point, I have the new order came in, X, and then when I sell it, it comes down to 0, and then when I make the order perfectly, when it's reached 0, and then the new order came in. So you can see the amount of inventory goes dynamically from X to 0, and then X to 0, X to 0. So on average, my inventory level is X divided by 2, right? X divided by 2. So my carrying cost, so my average inventory carrying is X divided by 2, and the each unit is the C, okay? So my carrying cost is X divided by 2 times C. So total cost is P times D over X plus X over 2C. This is my total cost. And there's one thing from math is that if you have two numbers, okay, A and the B, if the multiplication is a constant number, A plus B, the addition will have a minimum number when A equals B. Okay, so if two numbers, okay, if these are two variables, okay, if their multiplication is fixed, okay, and then the minimum of the sum of the two variable is actually when they're equal. Okay, it's when they're equal. So this is just math. I don't know. Think about, let's say, the area, right? The area is C equals C. Let's think about the rectangular area, right? If the area is C, what about the spherometers, right? So think about this. You have A and B. So A times B, this area, that's the area. This is a constant. So then what is the minimum of A plus B? What's the minimum of A plus B? So the minimum of A plus B will happen when A equals B. Okay. So I want to have the minimum of the cost. And I know this 2 the multiplication is a constant because the 2x cancel. So the minimum cost is achieved when PD over x equals x over 2c. So when I move them around, I have x squared equals 2PD divided by c. So x equals square root 2PD divided by c. Okay? So if you don't know this, that's fine. Yeah, just know this formula. Okay? If you don't know that, how I get this formula, that's fine. Okay? But it's better to know it. Okay? So because if you, let's say you forget this formula, but you know how to get it, so you don't have to remember this formula. Okay? So in this case, this is the picture that's going to help us to see that. When you think about the carrying cost, right? The more you order, your carrying cost will be higher, right? That's why this is the red line, right? This is the red line here. It's when you're ordering more, your carrying cost will be higher, right? The more you have when you order, you have to carry them in the inventory. So the carrying cost will be higher. And then this middle curve here, this one is the ordering cost, right? So the ordering cost is like the more you order, the more quantity you order, on average, the ordering cost will be lower, right? If you order more, that means you only order a few times a year. If you order less each time, you're gonna have to make more orders. Okay, so that is inversely related to the quantity is inversely related to the cost. So when you add the red line and the purple line, when you add these 2 lines up, that's your total cost. Okay? When you add it up, that's your total cost. You get this blue line. So this blue line is your total cost. Okay? And then you can see this total cost looks like a Nike mark, right? It's like a correct mark. It has a minimized value here. See? Right here. That purple dot, that at that quantity, you achieve the lowest cost of ordering. Right? At that point, your total cost is the lowest. Okay, and then that is the square root 2 times PD divided by C, right? So this picture shows the reordering point, right? So it's interesting here. For each order, I'm ordering 1,000 units. Okay. So as I'm selling this stuff, the inventory level is going down from 1,000, it going down. Okay. And it takes 4 weeks. It takes 4 weeks. I will sell the total 1,000 units. Okay. So this scenario tells me in 4 weeks, I will sell the 1,000 units. So on average, each week, I'm selling 250 units, right? So each week, I'm selling 250 units. In 4 weeks, I'm selling the 1,000 units, and my inventory level is 0. So if I know the lead time is 2 weeks, so by the time I place the order till the new order came into my inventory, that time is 2 weeks. Okay. If I want to get my new 1,000 units at the end of the first 4 weeks, I need to order 2 weeks ahead of time. Right? So if I ordered at week 2, I ordered another 1,000, right? That 1,000 will not come immediately here, right? So right now my inventory level is at 5,500 because this 2 weeks after, my inventory level has dropped from 1,000 to 500. But I cannot wait longer to reorder, right? Because it takes 2 weeks for the new order to come in. So I'm gonna make an order here, but I won't get it right away, right? If I get it right away, I don't have to order it ahead of time. So I ordered it here, and then the lead time is 2 weeks. So then the 500 units goes to 0. That's the end of the 2 weeks of lead waiting, and that's the time the new order came. So you have another 1,000. Okay. Safety stock. Safety stock is inventory held at all times, regardless of the quantity of the inventory ordered using the EOQ. So instead of keeping it to be 0, right? Maybe I should have a buffer, right? So that buffer will be my safety stock, okay? My safety stock. Safety stock is a buffer against the unexpected increase in demand. So demand can go up unexpectedly. Uncertainty about the lead time. If it takes longer, like COVID happened, you just cannot get the, you cannot get, so the supply chain suffers. You cannot get the stuff you want within the regular lead time. It used to take 2 weeks, now it takes 2 months, right? So if you don't have items, guess what? Your inventory is empty. That's exactly what happened during the COVID time, right? If you want to buy a new car, you have to wait for 1 month or 2 months because they don't have anything in the warehouse. Unavailability of stock from suppliers. So it could happen, let's say you are importing agriculture products, right? Corns, something like that. But what happened is the supplier you are dealing with, they have a very bad climate that year. So they don't have enough harvest, right? So they can't supply you the things you need. Okay, so this is the scenario. Suppose this is the column A is the safety stock level. Suppose I don't have any buffer, it's 0. Normally the demand is 500 units, right? So that's the normal sales demand. Okay. So suppose the demand has increased to 600. So the demand has increased to 600. You only have 500, right? You only have 500. Okay, you only have 500 left. Because here, right? So you reordered at this point. So you have 500 left. What happened is, let's say the lead time is longer, or maybe the sales demand is higher, right? It's higher. So it's instead of 500, the sales demand for that two weeks is 600. So now you have to quickly go somewhere to get 100 to meet that customer demand, right? So you had to order 100 units. Suppose the probability is 20%. So 20% of chance this is going to happen. What's the cost? The cost is each unit. Okay, if you have to get 100 units right away, right? The cost is $4 each unit. So 100 times $4, so that's the $400. Okay, but that's just one order, right? That's just for one order. In each year, there are 13 orders. So I will multiply 4, 5, 6, multiply your probability times the cost per order times the number of cost. So this is my expected cost, $10,040. In the scenario that only have a 20% chance, when the demand level increased to 600, there may be a 9% chance the demand level actually is 700. If it's 700, but you only have 500, right, buffer there for the 2 weeks. So now you have to do a stock out unit 200. And each unit is $4, so that's your $800. So you use your probability 9% times your stock cost per order 800 and times 13 orders. So that's 936. So the same idea, you may have a 6% chance that the sales demand is actually 800. You need to stock out additional 300, and the cost will be 1,200 per order, and then 13 orders times 6%. So that's a 936. Okay. So the idea is if your safety stock level is 0, so the expected cost is $29.12. So this is the cost you have to deal with because the sales increased, you don't have enough inventory, and this is the cost that you have to deal with, $29.12. Carrying cost is 0 because it's always 0, remember? You don't have any safety lock level, right? You have no buffer. You didn't carry any extra stock, so that carrying cost is 0. So the total of that cost is $29.12. Now, what if you have a buffer of 100, okay, units? When you have a buffer of 100 units, so then if sales is 600, that's okay, right? Because you have 500, you also have a 100 buffer, so total is 600. If it happened the sales to be 600, that's totally fine, right? The situation is, what if the demand is 700? So 700 minus what you have is 500 plus 100, 600. 700 minus 600 is 100. And remember, this is 9% chance, right? 9% of chance for 700. And this one, 100 times $4, 400 times 13. So you have 486. And now you have 6% chance of 800, 6% chance, right? 800, 6% chance. And in this case, you have 500 plus 100, the buffer, so 600. So 800 minus 600. So you need to stock out additional 200, and each $4. So that is the total $800. And 6% chance times $800 per order times 13 orders equals 624. So that scenario, for 100 safety stock scenario, the cost will be, adding this two up, 1092, right? 1092. But in this case, you are carrying this $100 stock all the time, right? And the cost is 5.2 for each. So 100 times 5.2. So that's the 520. So when you add them up, you have 1612. Now you increase your safety stock level to 200. So you used to have 500, and you plus a buffer 200. Together you have 700. So even sales demand reach 700, you are fine. But they are not fine when you reach 800. So 6% chance you reach 800. You need an additional stock out 100 times $4, 400, 6% chance times 13 orders. So you get 350, 312. But in this case, your carrying cost will be higher. So 200 times 5.2. So that's the 1040. Add them up, you get 1352. 1352. And then if you carry your safety stock level is, let's say it's 300. If you carry more, 300, so 500 plus 300, so 800. So sales demand is fine as long as they are not over 800, right? So there's no stock out cost, 0, but they do have a carrying cost. So 300 times 5.2, so that's the 15,600, 1560. So total cost is 1560. So you can see, right? When you compare these numbers, this number is the lowest, right? This number is the lowest. So when you carry 200 safety stock level, that seems to be optimal. So just-in-time procurement, right? Just in time, it tells you that they are trying to have a very low inventory level, okay? So they reduce the cost of placing a purchase order. How can they reduce the cost of placing a purchase order? They have a long-term purchase agreement. So in that agreement, they will define the price and the quantity, right? Terms. And the companies will use electronic links to place purchase order at a small fraction of the cost of traditional method. Okay. So basically, they are ordering less quantity, but they will have more number of orders. How can they keep it cheap? Because they have a long-term purchase agreement. So they use electronic links so that the ordering cost is only a small fraction of the cost of traditional method of ordering. Right? So using electronic links will save the amount of ordering cost. So that allow them to order more times, right? And each time is a smaller economic order quantity. So the strategy is called a demand pool manufacturing system. Okay. So this demand pool manufacturing system completes each element in a process just as it is needed by the next step of the process. The demand trigger each step of the production process, starting with customer demand for finished product and working backward. So I remember, so maybe in 2017, I purchased a couch from Taiwan, I believe. So I went to the furniture store. I made an order. I want this one. They told me it's going to take 2 months. I said, how come it's going to take 2 months, right? You don't have the stock in place. And he told me that no. He said they will receive this order and they will pass this order, customer order, to the factory in Taiwan. Okay. And then the factory in Taiwan, they don't have this furniture. They are ready to be shipped. They get order and they are going to make it. Okay. That's why it takes very long. It's probably take them 1 month to make it, and then take another month to ship it from Taiwan to Canada, right? So I waited for a long time. So this is kind of the demand triggering, right? So the factory received a customer order. That's the demand trigger. And right away, they're going to say, oh, this product, what materials do I need? Who should do this work, right? So right away, they will start planning. So they think about this product, and then they work backward to figure out what are the input required, right? In that way, they don't have to carry on unnecessary amount of inventory, right? So they know exactly what kind of materials, how much is required for my product, and that's how much they're going to need, okay? So then they will save, on the carrying cost, right? Production is organized in manufacturing cells, a group of all different types of equipment used to make a given product. Workers are hired, trained to be multi-skills, right? They can do different job tasks. Defects are aggressively eliminated, right? So they want to make the product, they want to make sure the product is good quality. When you ship the product will not be returned, right? Because you think about the product is returned, what are you going to do, right? You have to make another one. So setup time is reduced. Suppliers are selected on the basis of their ability to deliver quality materials in timely manner, right? So let's say that manufacturing factory, they have suppliers of lumber, wood, leather, right? These are the materials to make my furniture, right? So they want to make sure when my order passed to the factory wants to make sure the suppliers can give them the materials right away so that they can work on it, right? So they want to make sure that they have the ability to deliver the quality materials in a timely manner. So relevant inventory carrying cost consists of relevant incremental cost and the relevant opportunity cost of capital. So basically, you think about the carrying cost, there are two aspects, right? First of all, to carry additional items, units, each unit will cost more money, right? Second of all, if I don't use the money here, I use it somewhere else, how does that money will help me, right? So there is the opportunity cost, right? So opportunity cost can be very significant. So sometimes you think about a teacher, right? In the summertime, they can either choose to teach a accounting course, or they can choose to take a vacation, right? To enjoy the summer, right? Because the summer in Canada is very short, right? And that's the best season. People want to get some sunshine, do some activities outside, right? It will be a tragedy life for a professor to be in the classroom teaching students during the summertime. So what I can say that when you compare winter time versus the summertime, the opportunity cost for the professor is much higher during the summertime, right? They were paid the same. It's not like the professors are paid higher for teaching one course in the summertime, but the leisure they give up, right? Because the wintertime, if you don't go to teach, where else you go, right? It costs too much money to go to Hawaii. Too bad you stay in Canada and you can't go outside. It's raining, so you might as well just go enjoy teaching, right? So the opportunity cost is very low in the wintertime, but in the summertime, right? Everyone is having fun, right? The daytime is longer. The weather is beautiful. Sun shines, right? You don't get it very often, right? Yeah, so the opportunity cost is very high, right? In the summertime. So here is also you have the money, additional money. If you use that additional money to buy additional units to carry in your inventory, or you use that money for something else, right? It's important you choose the suppliers carefully, okay? And it's all important that you have a stable, long-term, good relationship with the supplier. As we can see how important it is to have high-quality product, high-quality materials, and deliver it on time, right? So what's the benefit of the just-in-time inventory management? So it reduces the need for materials handling, warehousing, and the inspection, leads to lower overhead. You don't carry that many inventory, right? You don't have to move them around. You don't have to inspect them. So this would result a lower overhead cost, and the inventory level will be lower, and lowering the carrying cost will be lower. Okay, and the manufacturing lead time is shorter. Okay, manufacturing lead time is shorter. The GIT, just in time, reduce the cost of placing a purchase order because they have a long-term agreement. The price quantity terms already been defined. They just need to use that link, right, to make an order. It's much cheaper than phone calls or mailing, traditional method. Supply chain is very important. Nobody can deny the importance of supply chain, especially since during the COVID-19, right? So what is the supply chain? This describes the flow of goods, services, and the information from initial sources of materials and service to the delivery of product to consumers. Supply chain members share information, plan coordinated activities. Supplier evaluate are crucial to the just-in-time purchasing implication. Okay, so if I'm having a just-in-time system, it's important that my supplier is also part of it, right? Because if I need 100 units now, how quickly my suppliers can supply that things to me, right? If suppliers cannot do that, then you failed, right? The total system failed. So maybe as a supplier, maybe they should know if they have a product in Walmart, right? Maybe they should have data keeping track of the level of the inventory of the product, right? So before even Walmart is asking, they should make sure they have enough quantity things ready to be shipped to Walmart, right? As soon as their inventory level achieved a certain lower level, right? Warning level. Suppliers has to be also part of this. Performance measure and control. So inventory turnover ratio. So the level of inventory is lower, that's going to affect the inventory turnover ratio and the days inventory in hand, right? So when your inventory level is lower, your inventory turnover ratio will be higher, and the days inventory in on hand will be shorter. So this would be the financial measures. So non-financial measures would be manufacturing lead time, right? Manufacturing lead time. How long do I wait for 1 month for my couch, or do I have to wait 3 weeks or even 3 months? Units produced per hour, that's the efficiency. Setup time as percentage of total manufacturing time. You don't want your setup time too long, right? And number of defective units. This is about quality control. You would like to control on the number of the defective units. Inventory management, materials requirement planning. Okay, this is the push-through system that manufactures finished goods for inventory on the basis of demand forecast. So they rely on the demand forecast of the final product, how many I can sell, right? And then they will determine their production, right? So they don't just produce for the sake of production. They first forecast the demand, okay, and then they will decide what materials, how many components, and the quantities of these materials components, so that they can finish the production. They have to take account of the lead time to purchase materials, right? So if they need the materials in 1 month, right, because the Christmas is coming, right? They need to start production in November, but they have to consider the lead time. Let's say the suppliers will make the delivery. It's going to take the suppliers 2 weeks. So then you have to, right, acquire the materials, making the order 2 weeks before November, so that you can get it in November, start using it, right? You set a master production schedule, specifying quantities and timing of each item to be produced. The output of each department is pushed through the production line, whether it is needed or not. Okay, and the push through may result in an accumulation of inventory. Enterprise resource planning. This improves the internal business process, flowing information. So basically, that system will help with the internal business process. If you think about the balanced scorecard we have learned, you have 4 aspects. You have financial, you have customer, you have internal business process, you have growth and learning, right? So to improve the internal business process, to facilitate the information sharing, right? So then they have these software modules, including accounting, distribution, manufacturing, purchasing, and the human resources, right? So you can see the labor, the materials, right? Overhead, everything, the information is there, right? So they integrate the information into a single database. Instead of different databases do not talk to each other, they put them together in the real time, okay? So that would be highlighting the interdependence of bottlenecks in the business process, right? So is it the manufacturing lead time is too long, right? Maybe the manufacturing, like the distribution team is just waiting for the items to be made, right? So, or maybe there's the backlog on the distribution. The distribution department just couldn't deliver. They didn't do a good job. So the warehouse is full. Production has to be stopped because there's no place to take new things, right? So when they have this whole system in the real time, they're able to see, to check, you know, how many percentage has been delivered, and the manufacturing lead time? Are they on time? Are they quicker? Or so they're able to see where is the bottleneck, right? Because things has to flow, right? In this value creation chain, things has to flow smoothly. They want to identify using that system with all information in real time to see like which area is the problem, is the bottleneck they have to deal with. Okay, so that's all I want to talk about this chapter. Thank you.